There's been a lot of talk about private investments, which is private equity, private debt, and so forth these days, and a lot of people don't really know what to think of it. This week, we're speaking with an expert in the field who's going to help us walk us through what the possible options might be and how they can help you to make better wealth decisions. This is Make Better Wealth Decisions, a podcast dedicated to helping pre-retirees and retirees manage risk and economic uncertainty by adopting a pension-style approach to improve your risk-return trade-off. I'm your host, John DeGuy, a portfolio manager with Design Securities in Toronto. This week, we're speaking with Benjamin Sinclair. He is an investment advisor and associate portfolio manager with Design Securities. He's both a chartered financial analyst, which is a CFA, and a chartered alternative investment analyst, which is a CAIA, which is a globally recognized credential for professionals specializing in alternative investments. His newsletter and podcast on private markets can be found at www.beyondtheexchange.ca. Ben, how are you this morning?
Wonderful. And thanks for having me, John.
I've wanted to speak to you for a while because you're a real expert in the alternative space. And I have spoken about alternatives from time to time on this pod. And I thought it would be worthwhile to get someone who's got some broad expertise on the subject matter to speak to it. So let's begin with first principles. How would you define alternative investments?
Well, there are lots of different definitions used by different people, but at a high level, alternative investments can be a term to describe any investment outside of the typical world of stocks and bonds. So that would include private markets, it could include hedge funds, and it could include other nichier type strategies like crypto or collectibles.
Okay, good. So with that in mind, let's see if we can dive into that world, which is a bit foreign to a few people here. So I have heard in the past that about half of the world's stock market capitalization is in private markets, give or take. Not the things that trade on a public stock exchange, which is, again, the whole point of your newsletter and your website, Beyond the Exchange. So is that about right? What would you say is, have you heard any information maybe more recent with regard to how much of the world's stock market value is not in stocks that trade in stock exchanges?
Well, I've seen different numbers from different people again. What I would say is the way that private markets specifically is measured, so things like private equity, private credit, private real estate infrastructure, and some other smaller strategies are actually much smaller in notional value than what you would see on the stock market. So some numbers from Apollo last year would say there's about 100 trillion in stocks, 100 trillion in bonds, 100 trillion on bank balance sheets. And then private markets would only be about 15 to 20 trillion.
Okay.
Now, those numbers may be a bit stale by now, but the point is, if you look at private equity or private credit or private real estate strategies, there's still a long runway left to go. And this whole notion that it's saturated or there's too much capital out there chasing too few opportunities, it just doesn't match with the numbers at all.
All right, so let's talk about this from a portfolio construction perspective. I'm a big fan of the work that was done by Harry Markowitz with regard to modern portfolio theory and combining different asset classes to get a better risk-adjusted return. When you think about the risk associated with, and we'll talk about liquidity or illiquidity in a moment, but let's just talk at a high level right now about risk and return and using assets that most people don't use as part of the portfolio construction process. What are your thoughts on that?
So when done right, private markets really accomplishes a couple of things. One is if you are able to sacrifice liquidity, if you do have a longer term time horizon, you can give that up in the pursuit of better risk-adjusted returns, whether that be on riskier strategies like equity or more resilient strategies like credit. The idea is that you would make that trade-off, and there are lots of people who are in a great position to make that trade-off. And then the other major benefit that one would seek from including these strategies is better diversification, which is especially relevant now because you're seeing stocks become a lot more correlated with each other. And since 2022, you've seen stocks become a lot more correlated with bonds as well. So that diversification element combined with the better risk-adjusted returns at the asset level is really what investors should be seeking in private markets in exchange for giving up that liquidity.
Okay, so let's see if we can take a moment to dive just a little bit deeper into the specific components of alternative investments. Can you maybe take a moment to walk us through what it means, what you mean when you talk about private equity or private debt, private real estate, private infrastructure? What sorts of things are people investing in if they invest in those asset classes?
So let's zoom in on the different private asset strategies. And I'd say a key theme across each of them is that you're not really investing in something that much different than you are outside of the public markets. It's just under a bit of a different construct. So whether you own a stock or whether you own a private equity fund, either way, you are investing in a fractional ownership of a business or of a collection of businesses. Same thing on the credit side. Whether you buy a public bond, whether you buy a private credit fund, you are still, in effect, lending money to businesses. Real estate, same thing. If you buy a public REIT or a private REIT, you are owning a share in buildings. And I would throw infrastructure in there as well. There are ways to invest in infrastructure assets through the public markets or the private markets as well. So that's really the way that I like to present the framework. It's that whether you go from public or private, you're not really investing in a different asset class per se, but you are doing it in a different manner. And by doing so, again, you can seek better risk-adjusted returns. And there are also strategies in the private markets which are easier to access, so you can get that better diversification too.
But we haven't talked about one of the elephants in the room right now, which is not everyone can buy these things, because in order to buy a lot of private equity and private debt and so forth, oftentimes you need to be what's called an accredited investor. And that's a proxy that regulators have come up with to get a sense of how sophisticated you are as an investor. That means you have to have a certain income or a certain amount of net worth, or you invest a lump sum dollar amount in order to get in. Most people are not accredited. It's really only maybe the top 5 or 10% of Canadian earners or investors, unless, of course, you're working with a portfolio manager, because the portfolio manager will effectively do the due diligence for you and make sure that everything is suitable, even if you're not accredited personally. What are your thoughts on where the rules are with regard to accreditation? Who can get in? Should they be raised, lowered, stay where they are? What do you think and why?
First, I'd rather just step back a little bit from the rules and talk about who should be invested in these strategies. And if you look at what institutions do, if you look at what ultra high net worth people do, they are heavily invested in these strategies because they can afford to take a long-term view. They can afford to handle the ins and outs of it. They understand these strategies, and they're not going to be surprised by what can happen in the next few months or years by these strategies. If you look a step down at individuals, there are lots of individuals who fit that description too. There are lots of individuals who are able to take a longer term approach. There are lots of individuals who can afford to take on illiquidity. There are lots of individuals who understand these strategies and who have the same goals as ultra high net worth people. So whether or not the threshold is 250K or 500K, whether or not there are certain income thresholds as well, it is up to the regulators. It is also primarily up to the advisors to make sure that it is those sorts of people who are put into these strategies, so that if and when something goes wrong, that it doesn't end up victimizing the wrong people. And I think that we can get to a point where we reach that, where the right people are invested in these strategies. But let's face it, private assets going into the wealth management channel or going towards individual investors, it hasn't always gone to the right people. And that's largely because it's still quite a new phenomenon. And there are still a lot of things being figured out on both sides of the border. So I have a lot of faith that things will get better, but I'm also not so naive to believe that we're there already.
Right. Okay. So what I think the word that you didn't use that I have used in the past is democratization. A lot of what is happening is private assets are making their way into retail portfolios more recently in the past 5 or 6 years relative to pretty much any point in the past. And I think that is likely to be on balance, a good thing, but it's not without its challenges. One of those challenges, you've already touched on it, is liquidity and the lack thereof. And so there are lots of products where they've, I think in the past number of years, there have been a larger number of so-called evergreen products where you can get out, but you're not being tied down for 3 years or 8 years or whatever it is, as it would be for certain more traditional legacy products in the space. Now, based on these structures, you can get out after 90 days or 120 days, but that's still a concern with regard to liquidity, and we haven't even touched on gating. So can you please take a moment to walk us through your thoughts on liquidity in general, and then from there, gating in particular?
Okay, so first, let's define what evergreen products are, and let's make sure that we understand what those products are. Evergreen products at a very high level can be thought of as behaving somewhat similar to mutual funds, except instead of this fund holding liquid stocks and bonds, it would hold private assets, such as private equity or private loans or buildings or infrastructure assets. So you're right. That means people can subscribe really at any time. So usually on a monthly basis. And when they decide to redeem, then there would be windows where they could redeem as well. Now, evergreen products have a lot of wrinkles to them that mutual funds that hold stocks don't have to deal with. So, for instance, if someone wants to buy into a mutual fund, you know what each of the underlying assets are worth because they are publicly traded. There's a listing for them. There's a price for them. It's updated continuously. If the underlying assets are not traded on an exchange and they're private, then it is up to the asset manager, ideally with an unbiased third party, to determine a proper valuation that people can buy into and subsequently cash out with. The other major hiccup or the other major challenge that you alluded to is the illiquidity factor. So if you are in a mutual fund and you want to cash out, that's a relatively simple process. Money is raised from the fund by selling liquid securities. That money is then returned to you as you cash out. If you are invested in a fund that holds illiquid assets and there is not a proper market for those assets, at least on a short term, then things become a little bit more complicated. The way that fund companies deal with this is they'll have caps, typically 5% per quarter, that they're willing to cash out. Okay? So if there's just one person, if there's one small investor that wants all of their money back, that's not such a problem. If half of investors want all their money back at the same time, then they are effectively told to get in line, which is the gating aspect that you alluded to. So at a high level, those are the hurdles that anyone would have to face when investing in private markets. But you are correct. This is still by far the most practical way for individual investors to invest in alternative strategies. And when done right, it does allow people to build portfolios that mimic those of institutions or the ultra wealthy.
Or endowments or pension funds or anything like that. You think of the Canada Pension Plan. One of the things that I know you've mentioned in the past that it's I don't want to go around, I wouldn't go so far as to call it a benefit, but it's a consideration that people maybe don't always have at the top of mind, and that is ease of selling. If you can get out in T+1, you sell on Tuesday, you get your money on Wednesday in a mutual fund or a stock or whatever, or even the same day. It might take 90 days or 120 days for a private asset offered via offering memorandum. That can sometimes be a good thing because the ease of trading has in the past, there's a lot of research that shows that people that trading correlates negatively to performance, and trading more often, trading more frequently. Oftentimes, you incur more trading charges. You oftentimes incur more taxes. But people think they're smart and they trade a lot. And you could trade stocks and bonds, 14 or 15 times in the time that you're waiting for one redemption to be completed for a private product. What are your thoughts about over trading?
Well, let me just repeat what you said in even plainer language.
Okay.
The research is out and the research is consistent. And the more you trade, the worse you do. And we hear these quotes all the time. It's not timing the market, it's time in the market, right?
Mhm.
How often do we hear that? We always
What?
hear about the importance of investing for the long term. We always hear about the importance of staying invested when markets are down or when times are scary. We always hear the importance of not trying to time the market. And yet, when it comes to illiquid products, very often people will cite illiquidity as such a major problem. Remember though, if you're an investor that's, let's say, in your 40s, retirement is, let's call it 20 years away. You don't need to have the option of cashing out your entire life savings next week. So it's important that people understand this, because when they don't, then there can be a problem. But if you can afford to take that longer term view, why would you even feel the need to give yourself the option to trade in and out of your investments when research has shown that that is not beneficial at all?
So a lot of people, I'll go one step further. There are a lot of people that might already be retired. Let's say you're 67 or 68, you've been retired for a couple of years and you're now obligated to take money out of your RIF, and you have X number of dollars. You could easily put a certain percent, and I don't want to use a number, but a fraction of your net worth into a variety of relatively less liquid things that might take you 3 months to get out of. And you have to have your RIF payment made in December. You've got other things that you can sell, but if you wanted to sell some portion of your less liquid assets, just sell them around Labor Day. You'll have the money for year end, and it's not really it's a very modest constraint, in my opinion. I mean, it's something in case for whatever reason something changes, but it's not exactly a major concern.
Well, you didn't use a percentage, and I won't either. But what I will say is that the percentage of illiquid assets that people can take on, even in retirement, is still a lot higher than the percentage of assets that are illiquid that people actually have in retirement. We're talking small numbers here. And again, this is something that has to be done responsibly. And there has to be obviously a framework in place. And then as well, for people who are more in need of income, they would likely be better suited for more income producing strategies in both public and private markets than perhaps higher risk, higher growth, lower income type strategies. But you're right. There is definitely a framework for people to have at least a slice within private markets and still make that part of a solid retirement plan.
So we haven't talked about percentages, so let's not go there. We'll just leave that for the time being and talk at a high level here. We've talked about a number of different private asset classes. And one of the things that we haven't mentioned yet is that there are certain products available which will, in a single ticket solution, offer exposure to multiple different asset classes, so that if you can't decide whether you want private equity or private debt or real estate or infrastructure or hedge funds or crypto or whatever, you can find a way to get a basket of all those things with a single purchase and have that there. What do you think about those sorts of options?
In many cases, they're the best option. So this is not just for investors that are unfamiliar with private strategies. There are lots of advisors who are still quite unfamiliar as well. And that's understandable. There are lots of advisors who've been around a long time in just a stock and bond construct. And this is all quite new. And There's a lot of due diligence work involved in this. So very often a single ticket solution is more practical. On top of that, there can be a lot of legwork for investing in an individual private markets fund. There could be extra tax forms, for instance, which can make for a lot more work. These all-in-one solutions are really going to be a big part of the future of private markets, again, on both sides of the border, in Canada and the United States. And we're already starting to see some solutions come out, some good solutions, and I would expect to see more as well.
Perfect. Okay, so the podcast is called Make Better Wealth Decisions. Yours, of course, is called Beyond the Exchange, and I would encourage people listening today to check out to Ben's podcast. But before I leave you today, Ben, I want to ask you the question I ask everyone else. Make Better Wealth Decisions is the podcast. What advice would you give listeners to help them make better wealth decisions?
What I would say is, whether you're in public or in private strategies, find a way to be comfortable trading less. So that could mean paying less attention. It could mean taking less risk. It could mean going more into illiquid strategies. But being in a position where you can take more of a hands-off approach, it could even mean going from self-directed, buying your own stocks, to going with a professional financial advisor like John. Mm-hmm. Being in a position where you can take a more passive approach. Research has shown that you'll end up better off. And frankly, I would argue it's a much better lifestyle as well, where you're not constantly sweating about which investment you should make in any particular week.
Perfect. Thank you so much for your time today, Ben. It's been a real pleasure. I want to wish you all the best going forward.
Likewise, John. Thanks for having me on. It was a pleasure.
If you're worried about the current investment climate and your money, go to my website to book a call for personalized advice to assist you in feeling secure and protected about your retirement.